So applying for a loan to buy a house can be a lengthy and confusing process, especially if you're a first home buyer. All you want to do is go through the whole home loan process without any hassle. There's many things that you might not know because, well, your focus is on buying the house that you want, not on the actual lender. Because let's be honest, nobody really wants a mortgage, they want a home, and if you apply at the wrong time, you could potentially lose some money if you put an offer down or if you get declined. So that begs the question, what should you actually do before applying for a loan? Hey guys, welcome back. My name is Fyzee. On this channel, we look at Australian personal finance, and today we're looking at the 3 main things that you need to consider before actually applying for a home loan. Now, as always, we are talking in a general sense only. This is not financial advice. I'm not a financial advisor, but I have worked as a mortgage broker and I have dealt with so many first home buyers, and these are the main things that they should look at. Number 1, living expenses. Now, if you've been doing research, you have probably heard about this already, that banks look at expenses, and that's very true. However, not every single bank looks at expenses, but we'll get into that in a second. But for the banks that do look at expenses, they look at the last 3 months. So what happens with those banks is that they usually request 3 months of your normal everyday banking statement. So this account will often be the one where your main salary goes into, and sometimes they will also be looking to see if the actual salary credits match up with your payslip. Now, if you're one of those people that has many accounts for your everyday spending, maybe you've got accounts with different banks and sort of different products that you have, and you want to somehow try and hide your spending, with some banks, if they see regular transfers across accounts or across outside banks, they will actually ask for those statements as well to get a more clearer picture. So if you're planning to somehow hide your expenses, don't try anything like that. It's really not worth it. So the bank will go through the last 3 months of your everyday statement and they will look for a few things. Number 1, if your pay is matching up all right with your actual pay slips. Number 2, seeing if you have any other debts which you haven't told the bank about. This is a very big thing. Number 3, your actual living expenses. Now, if you've got a stable job, generally speaking, you should be okay with number 1. But with number 2, you might think you're okay and you might think you've told the bank everything that there is possibly to tell. But if you've got an afterpay or zip pay and you haven't told the bank about this, this is classed as an additional expense as well that you need to declare. So with your expenses, how banks work it out is that they take the higher of 3 things. Number 1, what you actually told them on the application form. Number 2, what they can see in your actual bank account statement. Number 3, what the banks declare as the minimum expense for your scenario. And this is also known as HEM. So out of these 3 options, they will look at whichever is the higher, and that's how they will look at your expenses. And then with your afterpay or zip pay, generally speaking, that will be added on top of those expenses. So as an example, if you've got a family of 4 and you normally spend $3,500 per month as per your normal bank account statement, and the bank considers $4,000 per month to be the minimum for your scenario, they will assess your application on the $4,000 per month. And ideally, this is the better option because this will generally give you the highest borrowing power. Because in a different scenario, if you're spending $5,000 per month and the bank estimates your expenses to be $4,000 per month, then they will go off the 5K. This is why it is important to keep your expenses at a reasonable amount at least 3 months before applying. Because normally banks do an average over the last 3 months, and if your expenses are higher, this will unnecessarily reduce your borrowing power. And it's the same thing with zip pay and afterpay. If you can pay those out, it'll be good for your borrowing power as well. So as I said earlier, some banks don't request your actual account statements. They normally go off of what you told them in the application form. But as a first home buyer, the chances are that you or your broker might need to check with different banks. So that's why you want to make sure that your expenses are all good, and this is more to be safe. Now guys, if you're finding value so far, please hit like or subscribe. It really helps out with the YouTube algorithm. Number 2, be in your job for at least 3 months. Now this rule is different for each bank, so I'm saying 3 months as a general guideline. Because the thing is, as a first home buyer, chances are that you will need to pay LMI. So when it comes to LMI, the requirements are just a tad bit stricter because on the bank side, there is more risk. Therefore, they want you to be in your job for at least 3 to 6 months or have the previous industry experience. Now, once again, not every bank will want this. Some banks are okay if you've been in your job for a very short time, even if you're a first home buyer. But as a first home buyer, you want to be able to choose with as many lenders as possible, and this will maximize your chances. And essentially, it will give you that flexibility. Now, in this whole example, I'm just talking about part-time or full-time work. But when it comes to casual, the rules are a bit different as well. Now, generally speaking, with casual, you need to be in your job for at least 6 months. Now, I fully understand that that is a super long time. I get it, but it's for a good reason, because 6 months of history gives the bank enough confidence that your income will be hopefully ongoing. And especially with COVID and whatnot, you can see why this is a requirement. Now, there are some banks which are okay with even 3 months in your casual position, but you would need to check with your broker in some situations. So it's best to go through a broker to get that assurance, especially if you're borrowing over 80% of the property's value and you need to pay LMI. Now, speaking of LMI, I have made an in-depth guide to LMI, basically everything about it, what it actually is, how to avoid LMI, and how you can save thousands as well. And if you want to know how it all works, there should be a pop-up on the screen right now, or there's a link in the description as well, so go check it out. Now, last and final, number 3, which is have your deposit in the account for 3 months at least. So banks have this thing called genuine savings. You might actually have heard about this as well. So basically what this means is that according to the banks, your savings are genuine if you have been consistently saving over the last 3 months, and they can see that through the actual statement. So basically they're looking for that upward consistency. If you are planning to sell your shares for the deposit, usually that's fine as well if you've held the shares for some time. Now, with this genuine savings, banks want at least 5% of the property's purchase price as your genuine savings. And the reason why is because according to them, it's a good sign of character, because if you can consistently save for 3 months, generally speaking, you should be able to pay off your home loan consistently as well. Now, keep in mind that this genuine savings rule is not always required. For example, if you're not paying LMI, meaning that you actually don't have to keep the deposit in the account for 3 months if the LVR is going to be below 80%. But if there is LMI, genuine savings are required, so just keep that in mind. Now, if your savings are not genuine, some banks are okay with accepting a rental ledger from a licensed real estate agent. So basically this shows the bank that you have been consistently making repayments on your rent, therefore you should be able to pay off your mortgage on time, theoretically at least. And it shows the bank that you have been using your savings to pay off rent, that's why your savings aren't really genuine. So it sort of paints that picture. Now, every bank doesn't actually offer this, so please check with your broker. Now, let's say that you're buying a property for the very first time and you don't actually qualify for the government grants. For example, you might be buying an existing home, and usually the grants are only on new homes, so you won't be getting the first home owner's grant and the other grants as well. So then generally speaking, you will need an 8 to 10% deposit. The 5% deposit just won't be enough, because the cost of LMI needs to be factored in as well. So I will make a separate video on this topic for you guys. Now, surprisingly, there are a few ways to buy a house in Australia with zero deposit. Yes, zero, but it is not for everyone. And if you want to know how, there should be a pop-up on your screen, or there's a link in the description as well, so check it out as well. Well guys, that's it. Hopefully you can follow these things and be fairly confident when applying for a loan. Once again, I do recommend a broker because they can check everything with different banks and just get a deeper understanding of your situation. And most importantly, you can have that peace of mind. Well, thanks for watching guys. Please like and subscribe if you enjoyed the video, and I'll see you in the next one. And it shows the bank that, and it shows